Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only and doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the S&P 500 up on the screen, and is this the start of the long-awaited pullback? Well, so far it's only one down day, so I think it's a bit early to declare that the rally's over. Of course, I'm recording this on Friday afternoon in Sydney, so I don't have the benefit of Friday's price action from the S&P 500. But I think what we can say from an overall trend perspective, the bullish trend is still very much intact. We still have a market that's trading higher above rising moving averages. So I've got the 50-day and the 100-day moving averages. And the moving averages themselves are showing no sign of rolling over or flattening out. So I think that the default position should be that the underlying conditions remain bullish until, of course, the price action tells us otherwise. And as I say, one down day isn't really going to tell us otherwise. I think that trying to call tops in an established bullish phase is often a losing game. And I think back through the over the last 3 decades that I've been in the market, and it's full of occasions of prominent traders, of investors, analysts coming out and predicting a top in the market, whatever period it may have been in, and then being completely wrong for months, wrong for years in some cases, but persisting with their predictions. And I've done it myself. I've learned the hard way in the 1990s that just because you think a market should fall doesn't mean that it will. But having said that, I don't think this is a time for complacency, because this has been a strong run over the period since October. And an interesting graph appeared on my Twitter feed through the week. Let me just quickly show you. This is showing the it's a AA US investors sentiment bearish readings, showing on an 8-week rolling moving average basis. And so this is basically the number of bears in the market, the percentage of bears. And as you can see at current levels, it's about as low as it's been over the last decade. Doesn't normally get down to this sort of level. So I think that just looking at this on its own, I don't think this is a signal to go out and sell. But I think it does highlight that the bullish trade, it is getting crowded. It's that seems to be the way most people want to play this at the moment. Now, I still think that well, look, let me just go back to our S&P 500 chart. There's what I think like taking that graph into account. I think there's a risk that the late money, so the people who have been buying over the last month, people who have come in late to this rally, started to come into the market, there's always a risk that they get spooked, and this sparks a larger pullback. Is that money then the money that's come in late is the first to depart, and maybe that can bring about that retest of the 50-day moving average, which hasn't happened for quite a while. You've got to go back to November to have the last test of the 50-day moving average. I still think the most appropriate strategy is to let profits run. So I think for anyone in positions which are in the money, which have been doing well, I think the play is to let those profits run. I don't want to get scared out of good positions on what could just be minor volatility, which could play itself out without too much fuss at all. But it's never a case of being blindly bullish. So this is why I'm always using those wide trailing stops to manage risk. And the reason I'm using wide stops on my stock positions, it's because I want to give myself the ability to see off modest and moderate pullbacks and stay on an underlying trend. Try and stay on a big underlying trend for longer. That's the key, I think, with wide trailing stops, because it gives you that ability to see off the chop along the way. And as I've been saying, I haven't been enthusiastic about buying the index, particularly over the last month. It's been a case of me saying, let profits run, but I'm not enthusiastic about buying the index. And that remains the case. And the reason for that is that it just doesn't have those asymmetric properties it had at lower levels. And when I say asymmetric, I'm talking about where the perceived upside potential is much better than the possible risk. So I just don't think this has been an asymmetric play for a while now. And this remains the case. I think we can be patient with our buying and just see what develops over the next week or two. Is this going to be a just another shallow correction, or could it develop into something that comes back to these moving averages? Now, if you're getting some value from this, please hit that like button, leave us your comment. Just, hey, thanks for the video. Just, it helps the channel heaps when you do that, because YouTube then goes and puts it in front of other people to have a look at. So please do those things and hit that subscribe button if you haven't already done so. Now let's wrap up with a quick look at the small caps, at the Russell 2000, and this has been an area of interest for me. It's one which I've really focused on over the last few weeks in the videos. I really like the risk reward dynamics of the smaller companies, and I like that they appear to be lifting off this large basing structure. So you just look at the decline we had during 22 into 23, big base in place, started to lift off this structure. And I've been thinking it's had the potential for a strong move to get underway as it's gotten above these previous peaks, gotten out of the range. I've thought, look, the potential is for this market to really start to lift off. It got to a 2-year high on Thursday. So it's had several goes at making these new highs. And so another one last Thursday, but again, it couldn't really break away and has since come back. It's at this point, I think the price action remains positive. It's continued to work its way up this rising moving averages, the 50 and the 100 day. The 50-day moving average has been working quite well as it works its way up. But of course, if the S&P and the Nasdaq and the Dow, of course, were to pull back, then it's only natural to assume the Russell's going to do the same. Almost certainly, you'd expect the Russell to do the same. We still have this series of higher lows and higher highs. I think if the Russell can hold this support, so maybe it does pull back. If it does pull back, if it can hold this support at around 2,000, just above 2,000, also the March low, if it can hold above those points or pretty close to them, then I think it would really be shaping up nicely. A pause and then potentially a breakout from there. But I think it's a case just at the moment, wait and see right now. Let's just see how the next week or two plays out, and take our cue from the price action as it continues to develop. So look, let's leave that there for now. Thanks for joining me. Great having you with me. Hopefully it's been helpful. Look forward to coming back, talking to you again next week. Till then, bye for now.